In the United States, your credit score plays a pivotal role in determining your financial health and opportunities. Whether you're applying for a mortgage, getting a new credit card, or even seeking employment, your credit score can influence everything from loan approvals to interest rates. Understanding the importance of maintaining a high credit score is crucial, as it directly impacts your ability to manage debt and achieve financial freedom. Why your credit score matters. A credit score is essentially a three-digit number that represents your credit worthiness based on your credit history. The most commonly used scoring model, the FICO score, ranges from 300 to 850. Lenders, landlords, insurers, and even employers use this number to evaluate how responsible you are with debt. Here's why it's important. Credit card statistics in the U.S. credit cards are an essential tool for building credit, but they also come with significant responsibility. Mismanaging credit cards can negatively affect your credit score. Average credit scores in the U.S. The average FICO score in the U.S. has been steadily increasing over the years. According to recent How to maintain a high credit score. Maintaining a high credit score requires discipline, planning, and understanding how credit scores are calculated. Here are some strategies you can use. 1. Pay your bills on time. Payment history makes up 35% of your credit score. Late payments, even by a few days, can harm your score. Set up automatic payments or reminders to ensure bills are paid on time. 2. Keep credit utilization low. Your credit utilization ratio, or the amount of credit you use compared to your total available credit, accounts for 30% of your score. Aim to keep your utilization below 30% of your available credit to maintain a good score. For example, if you have a credit limit of $10,000, try to keep your balance below $3,000. 3. Avoid opening too many accounts at once. Opening several new credit accounts in a short period can negatively affect your score. Each new application results in a hard inquiry, which temporarily lowers your score. Additionally, having too many open accounts can make you look financially overextended. 4. Build a long credit history. The length of your credit history contributes 15% to your score. Lenders want to see a consistent track record of responsible borrowing and repayment. If you're new to credit, consider becoming an authorized user on a family member's card to build history faster. Diversify your credit mix. Having a variety of credit types, such as credit cards, auto loans, or mortgages, accounts for 10% of your score. Lenders like to see that you can manage different forms of credit responsibly. Regularly check your credit report. Mistakes on your credit report can lower your score. Under federal law, you are entitled to a free credit report from each of the 3 major credit bureaus, Experian, Equifax, and TransUnion, once a year. Review your reports for any errors or discrepancies and dispute them if necessary. The consequences of a low credit score. A low credit score can result in several unfavorable outcomes. Final thoughts. Your credit score is more than just a number, it's a reflection of your financial responsibility. By keeping your credit score high, you open doors to better financial opportunities and long-term savings. With the right strategies, such as paying bills on time, maintaining low balances, and regularly monitoring your credit, you can keep your score in the optimal range and enjoy the financial benefits that come with it. Don't forget to like this video and subscribe to our channel for more. Disclaimer: we're not a financial advisor or financial professional in any capacity. These are just helpful tips that were found that might have helped some people that we thought we'd share. Please seek professional assistance about such matters before making important decisions.